when the market is dropping and dropping more and just getting obliterated, sometimes it seems like there'll never be a bounce. But the reality is, when markets sell off quickly and precipitously, there always is a bounce. That's what markets do. If you want to learn how to spot the signs of a coming bounce and play that bounce, stick around. Hi, I'm Steven Spencer. I'm a partner at SMB Capital, a proprietary trading firm in New York City where we trade stocks, options, and futures. So in today's video, we are going to talk about market bounces that follow after large market declines. Understanding how to spot the signs that are indicative of an increased probability of a larger sustained bounce is important. After a huge market down move, being positioned for a large bounce is tricky, but the risk to reward can easily be greater than 10 to 1. If you're selective on your entries and understand the potential upside for the market. Let's look at recent price action in the S&P 500 via the SPY chart and kind of talk about the signs that we're seeing right now and what I'm looking for going forward to play a larger market bounce. So the first chart that we're going to take a look at is the SPY daily chart. And what you can see right now, after today's market close, it's in a very steady downtrend. But let's take note of a couple of things. And the first thing is, if we go back to the end of February, the market was down at around 286. The SPYs were at 286. There's a few green days there, 3 out of 4 days. And this basically means that the close is higher than the market open. That means during the day, buyers were in control. The market opened at a certain price, it closed at a higher price, so markets controlled the price action for that day. So we saw the market attempting to bounce there and then move sideways for a few days, buyers accumulating at 300 or so, just above 300. And then we had a series of three gaps lower in the next 5 trading days. But even as we look at that downtrend, what you can see is 4 of those days, the market closed higher than it opened. So as we're moving lower, during market hours, buyers were attempting to move prices higher, and they did on several occasions. But these large gap downs have brought us down to the 240 area. Now, why is the 240 area important? It's an area where we sold off to in late 2018. We blew through it, we bounced back above it, and then we had a huge market bounce in late 2018 and early 2019. So this was an area that people had their eye on as soon as we started selling off above 300. It also coincides with a very quick 20% down move from where the end of February and the beginning of March, where some people had been accumulating. So this accumulating stock. So this is a very strong down move from recent prices, 20%, and a natural support area on a higher time frame moving out a couple of years. So that's why we're focused here, but at the same time, I understand the circumstances of how we got down to this level. The catalyst for what's causing the market to sell off, a global pandemic, is not really something that the market's seen before. And I'm very mindful that this is not the same as some of the sell-offs we saw from 2014 to 2016. If I had to, there were different reasons. I don't even remember even exactly what each reason was for those sell-offs. But each time we came off really hard into the support areas from the prior couple of years, I felt pretty confident that we would bounce from those levels. In that case, it was the SPY 182. We can actually even take a look. So you can see going back to 2014 to 2016, in 2014, we sold off from above 200 down to 182. And we bounced back up in 2015, and there was some sideways consolidation, and the market got hammered very violently from about 210 to 180 in a series of 2 or 3 trading days. But again, people were very fearful there. But what happened was there was a great distance in time. And what gave me great confidence to buy into the low 180s in that situation is when time goes by, and at this point it was almost 2 years, and you come back down to a price, the market essentially is cheaper. And when the market is cheaper, large fund managers are saying, wow, I can buy stocks now at prices that I was buying 20 months ago. And fundamentally, the things aren't that bad. I think oil had sold off at that point. But for the most part, outside of the energy industry, things were going really well. And that led to a very quick bounce. We did revisit those levels again in January and February of 2016. But I felt even better on those two revisits of buying because, again, stocks were even cheaper because the economy was doing well. I don't particularly remember what the catalysts were when we sold off, but earnings were good, catalysts were good, and we were now 18 months later from where we had bottomed in 2014, and so you're feeling really good. There was no global pandemic leading to a deep recession. Again, economic activity in the United States has basically sharply decelerated. I'm not sure what the really example is. When this happened, maybe the last time we had the flu in the early 20th century, maybe economic activity stopped then. But for the last, let's say 50 years, this is really unprecedented what's going on. And so I'm mindful of the bigger picture backdrop, but at the same time, when markets do sell off on an accelerated basis and stocks start to look cheaper to people, and when there's a lot of fear, those are ingredients for bounces. And so we did see over the last couple of days, you very well could say, as we're coming down to this 240 area, it would not hold. And if we zoom in, what you can see is over the last few trading days, we sold off on Thursday pretty hard to around 246, 247. The overnight futures low, I believe, was below 240 overnight on that Thursday. The next morning, we gapped up quite a bit. We gapped up to above 250, and we ended up rallying at the end of the day very strongly, but that was a Friday. And we know that almost every weekend this year in 2020, we have been selling off into the weekend, people have been concerned, and the news flow over the weekend, everyone at home glued to their televisions or glued to YouTube, I guess now is the thing, as the news is flowing, it was very negative. And we have not seen the market sustain an up move, since the bounce from 286 to 312. Since then, every $10 up move or $15 up move has been sold hard. But the interesting thing to me now, and I'm starting to see a shift, and we'll see if we can get confirmation tomorrow in the next couple of days, is we're in that 2-4, we gap down Monday morning, we're halt limit down, the market stops, because we're down more than 7%, and we open, we tick down, and then we get back above 240, and we ripped to the upside to around 255, 256. Now that didn't sustain. We reversed in the afternoon and closed down at 240. So coming into today, what are you thinking? The market's gapping up, we'll get below 240, market's gonna tank, we're gonna go down to, I'm not even sure where the next major support would be, maybe the 235 or something. But people are thinking much more downside, thinking, $15, $20 a downside at this point. There's a lot of negativity, which again, normally these are ingredients for a bounce. But, did I think high probability? I was thinking, okay, well, let's see what happens. If we flush 240 by a couple of bucks, if we actually look at my morning game plan sheet, you'll see right here, I have the levels on there, and this is really important. What I'm thinking is we're coming in, we're gapping higher. I think we're gapping to around 244 or something like that. And I have my 3 support levels, I have my 3 resistance levels, so I can use the price action in the first couple of hours to say, are people interested in buying today? And if they are interested in buying, maybe this is the beginning of something. So we had 238 as S3, 240, 242 as the first potential support, 246 R1, 247.5 R2, 250 R3. If the market blows through all of my support areas, then I start to think we're going to fail. This is not good. We could go to significantly lower prices. If we get through R2 on the open, and then maybe in the afternoon start to hold above R3, I'm starting to think maybe this is the beginning. We've tested 240 now. Yesterday we've tested 240 again. We get a close above R3. This can be the beginning of a larger bounce, and I'll get to what we need to see in order for that to happen. So that's what we saw in the charts. We closed today. We basically, I don't know, I actually did this chart I think before we closed, but we closed above 250, and now what we need to see is a little bit of a compression in volatility. Now, this has been going on for a couple of weeks now where we just haven't had that compression since, I guess, the beginning of the month. Today is the 16th, 17th, something like the 17th. We haven't really seen a compression in volatility in 2 weeks. So the first thing I would like to see is we're having these ranges of about $15. I'd like to see a sub $10 range or even a sub $8 range. And I'd like to see us start to hold above 254, 255, kind of compress in there a little bit. And if we can compress Wednesday, Thursday, and then break to the upside on Friday and close strong, I think that's a beginning of a larger move. First potential area of resistance, if we zoom out on the 30-minute for the last few weeks, what we can see is clearly I've X'd it for you there, that little range above 270, like 272 to 274. We had used that as resistance on the support on the way down. We actually gapped below that a few days ago. And since then, we have not been able to reclaim it. And this is the exact same thing I did when we sold off to 286. I had my first resistance area around 302 to 304, I believe. Then above that, it was 310, 312. Very quickly, we got to the second resistance area and then reversed. And so what we need to see tomorrow is, let's say we gap down tomorrow somewhere in the mid 240s or something. We want to quickly reclaim 250. We want to close above 254, 255-ish. We want to compress for a couple of days. And then we want to break to the upside, and we're playing for a move to 72 to 74. If this becomes a sustained bounce, I think best case, because of how much damage has been done to the market in the near term, is above 280. I highlighted 285, 286-ish. Even like the low 280s, I think would be a great move. 280, I think around 238 was the low today. So that would be about a $44, $45 move on a percentage basis. That's not quite 20%, maybe that's like 18% or 19, but that's 18 to 20% bounce off the low. That's pretty good over a week, 5 or 6 days, something like that. So compression of volatility is one of the things we're looking for. The other thing that we started to see today is as the news is flowing out. And so, one of the things I'll say for myself personally that I underestimated, we've been watching for about a month very closely the number of cases that have been developing outside the US. And there's 2 websites. I think I shared them in a prior video, perhaps. I can't recall. Maybe I tweeted them out. But I've been watching very closely, looking at the numbers, seeing how things are spreading and trying to get an understanding of what it's going to look like when it comes to the US. And I think because I was doing that, I was a little bit more comfortable as the news was starting to flow. And as we kept on failing and gapping lower and lower, I was like, wait a second, maybe only 5 or 10% or maybe 20% of the people in the US were ever paying attention. And so now as more and more people are starting to pay attention, there's more fear building up. But I think at this point, pretty much the entire country, with the exception of maybe some teenagers and some 20-somethings who are not paying attention to these numbers, and that anxiety is built up. So I'm not as worried, and we're starting to see that with the news flow, which is there were just certain announcements intraday that were coming out. New York City might go into a stay-at-home lockdown situation, which they did in San Francisco yesterday. And you could see the market just got hit for $2 or $3 pretty quickly. Market didn't like that, but boom, it bounced right back up from 47 to above 50. And we even got up to 52, 252, 53 on the SPYs. And we saw that in a few different instances. The other thing is the way that the government has been communicating and handling is actually improved. It's easy to, from just my perspective and most people's perspective, the information flow from the federal government has been horrendous up until the last few days. They're just, there is no pandemic, we're good to go. This was 3 weeks ago, it was like, we have 50 cases here, we're good, no problem. Now it's basically like, this thing may last through the summer, and that truth, telling people the truth, this is one of the things you hear from the experts, the medical people, the pandemic experts saying, just let people know what the situation is, and you get less panic and people not hoarding toilet paper and acting crazy. And so now that news flow on the federal level is good, on the state level it's been good for a while in New York State. They've been pretty frank. They're having meetings every day. There's a website talking about it. So I think now that everyone knows we are in a recession, and the other thing is the federal government, 2 things. Number one, the Fed responded on Sunday night by cutting 100 basis points. I don't think they've ever done that before, and basically said we are going to provide liquidity. 10 seconds on the Fed. The Fed's job is to make sure the credit markets function. I know everyone likes saying on Twitter they're glued into the stock market and making sure stock prices go up. Their job is to make sure the credit markets function, keep unemployment low and inflation down. They did that. And they're supposed to do that. And you shouldn't get angry that they did that, because if they don't keep the credit markets open, whatever recession we're experiencing right now is going to be much, much worse. You'll actually have a Great Depression. The second thing you need to do to actually deal with a contraction like this is get money in individuals' hands. And that's something that the federal government can do. It's called fiscal stimulus, fiscal policy. It was very difficult after the global financial crisis to get anything done because it was a Democratic president and a Republican Congress, and it was very difficult. Eventually, they did get something done. But this time, you have a Republican president, you have a Democratic House who definitely wants to spend and do fiscal stimulus, and then you got the Senate, Republican Senate, but they've got to actually listen to Trump or he can crush them politically. And so you have a perfect setup here for fiscal stimulus to happen. And the news flow on the fiscal stimulus, it started with the House passing something, a little rinky-dinky thing, but it was a start. And then the certain senators who normally would say no deficits, no spending, they're like, we're doing 500 billion, we're doing $1 trillion. And so the signaling from Congress, the signaling from the White House is whatever it takes to get money in people's hands. And there's a lot of people who are not going to get paid over the next few months, lose their jobs. Small businesses especially, and then also you have to worry about the big businesses not doing the right thing. That's always a problem. You got to get money from the federal government into people's hands so they can pay their rent, pay their bills, get supplies, and keep things going for the next, 2 to 5 months. We'll see how this shakes out over the next few weeks. But all those things are lining up. And so what you want to pay attention to, and there's a reason I was talking about that, what you want to pay attention to in the next few days as a trader and a person who's potentially putting on longer term positions, for the next week, 2 weeks, is as the news flow is coming out on the bills that are going to be passed, as the money is going to be, how is the market responding? Is it holding prices? Is it starting to move favorably higher? And then as you're starting to see more numbers come out, New York numbers are going to go higher, cases in New York City, cases in California, cases in Washington, the hot spots around the country. Is the market shaking it off, on these daily updates? If you're starting to see those things, that gives you more confidence to build into these positions and ultimately capture a larger move. Now, one final point I want to make. I tweeted out the other day, I think it was last week, if we get down to 240, I'm going to put on longer term positions. In the past, when we would come down to major support areas, I'd always be like, buy the dip, you got to do it. This time I was more nuanced or conservative, basically saying longer term positions, I'm going to do it. I wasn't so sure. I didn't have the 80% confidence level. We would bounce from 240 back to 270, 280. I was more like probably less than 50-50. But after today, I feel like the balance has shifted, and I'm feeling more like 60-40. We can move to the upside on a bigger picture bounce, and you just need to look for the signs over the next 2 days. That compression and volatility, how we react to the news, and ultimately a couple other things, market leaders, the Microsofts, Apples, how are they behaving? Are they holding above VWAP from today? Things of that nature. And you put that together, where your stops are going to be. You have price levels to trade against based on the price action from the last couple of days. And you have some risk reward here with those upside targets that we highlighted in the multi-week chart that we're showing you right now. As always, hope you learned something here. And if you have any questions about the price action that's going on, how we're trading this right now, bounces in general, please put them in the comments section below. And if you want to get a better understanding of the main setups that we use on our desk, check out tradingworkshop.com or click on the link above. And we go into detail the top 3 risk-reward trading setups that traders on our desk use to capture larger moves.